Welcome to Market Pulse by SC Securities and Daily FT. I'm Dilusha Gamage, representing SC Securities. And today, joining with me, Mr. Shehan Kure, the Director, Head of Research of Equity Stockbrokers. Shehan, welcome to Market Pulse.
Yeah, thank you for having me. Yeah.
So Shehan, to start off the conversation, now we are at a very uncertain time and the investors are worried and they are going through all these difficulties. Their portfolio values are coming down and the market is coming down. So what is the way forward for the investors in general?
Yeah, so I think a lot of investors will be taking a risk-off approach and shifting some part of their allocation more towards short-term fixed income and so on, and within that would be a sensible strategy. So within, like we said earlier, given that real interest rates will be negative for a while, you would need to stay, you would need to have some allocation for equity to try and offset what you're losing through inflation. So within your equity portfolio, what we recommend is to, we released our strategy report for the market earlier this year, where we gave our stock recommendations in the context of high macro risk, high inflation, high depreciation, exchange devaluation risks, and so on. So our narrative in terms of stock picking hasn't really changed. So most of the stocks that we picked in terms of counters that have high dollar-based income or purely dollar-based income, the ability to pass on cost increases to clients to offset inflation, or compelling valuations and growth stories. So all of that remains the same, except that valuations have reduced even further from where they were earlier this year. So most of the stocks that we had recommended earlier this year are now trading at maybe 4 times trailing PE, or even a few of them even lower, like the banking sector and so on. So what we would recommend is that investors, if they have liquidity, should bargain hunt and take a contrarian view and start picking up these counters at bargain prices. Obviously, that strategy is not going to make money for them soon, in the sense that we expect market conditions to be challenging for at least the bulk of most of the year. But if you take a longer term outlook, when you pick up stocks at these sorts of valuations, it's likely that you will make good gains on those with a long-term outlook.
Will you be able to give us some examples of that research, that stocks that you have been giving at the beginning of the year?
Yeah, so earlier this year we put a buy recommendation on Expo when it was when it went down to about 250 rupees range. Now it has come down even further. So Expo gets about 95% of its income from outside Sri Lanka. And when, at the time that we did our research, we were factoring in that exchange devaluation would be higher than it has been in the past, but not as high as what has transpired in terms of devaluation of more than 60% since the free floating of the rupee. And even if you take the view that the rupee has overshot, and once the it may even go a bit further in the short term, but once the IMF funding and so on comes back, it may regain some of its losses. It's still difficult to see it regaining much of the value that it has lost. So purely from a devaluation perspective alone, I think Expo looks more attractive. Now, of course, other things change, like the discount rates that we have used in our assumptions would need to go up with the rise in the interest rates and so on. But I think on a net basis, still the devaluation gain alone makes that counter more attractive. Some of the others would include the export-oriented companies like Haley's and so on. Earlier it was, I think at the time, maybe about 6-7 times on price to earnings. Now it's 5 times or less. The banking sector also at the time was mostly at about 4 to 5 times on trailing PEs. Now it's lower. Of the banking sector will have some headwinds in terms of provisions for ISBs and SLDBs and that they hold, and higher NPLs in the context of low or negative economic growth this year. But still, we think that will be partly offset by margin expansion from the interest rates going up. So, and also as a defensive sector, given that they are mostly low beta stocks, which will help with capital preservation in the current scenario. Some of the others would include, we had an overweight or neutral recommendation on HBS, which is a software company which gets most of its income from abroad, and also on HELA, we had an overweight rating on HELA because of the exposure to exports, and again, a large part of their business is generated offshore. So I mean, those would be the kind of stocks that we would be recommending. We hope to add maybe a few more to our list based on how the market prices react in the next few weeks. Yeah.
Okay, and also now the immediate impact of this current foreign debt default or the restructuring that the country is going through, yeah. How would be the impact for the listed entities and specifically maybe for the banking sector?
Yeah. So it's basically only the banking sector that would be having a direct impact from the ISB default. So most of the larger banks hold ISBs and SLDBs. So currently the SLDBs are not part of the default as per the statement that was made by the Ministry of Finance. So it's the immediate impact would be on the holdings of ISBs by the local commercial banks. So out of the listed banks, the top 3 are the ones that have significant exposures to ISBs, and those are also the ones that we have within our coverage. We don't cover the smaller banks, but they have a negligible impact on the ISBs. So what would happen is that we expect that the banks would have to make some form of provision for those ISBs. Mostly they're in the amortization cost portfolios of the bank, so they're not mark to market. So internationally, the ISBs I think are trading at about 40 cents to the dollar. So I think investors are expecting a significant cut on the coupons, and maybe about 50% cut on the coupon and 20% cut on the principal for the ISBs as part of the debt restructuring, and maybe an extension in the term of the bonds as well, 10 to 15 years. So in that context, the banks would have to write down the value of the ISBs that they hold. So based on the stress testing that we've done for the largest 3 banks that we cover, most of them have enough capital buffers to absorb the provision for ISBs. Then we've also done further stress testing to see whether in case there is restructuring required for the SLDBs as well, whether they would be able to absorb that. And the majority of the banks within our coverage can absorb that stress as well with their capital buffers. So the worst case scenario would be that there would have to be some sort of restructuring of the rupee bonds as well if the country can't bring about debt sustainability through restructuring of the foreign debt alone. But we think that's a very extreme scenario because it hasn't happened recently with most of the countries which have defaulted on their foreign debt. So we think the debt sustainability can be brought about through revenue adjustments and restructuring of the foreign debt. But even if we assume that there would need to be some restructuring of the domestic debt as well, and that it would have to be fairly small in the sense that you can't put undue stress on the domestic financial system. We find that the majority of the banks that we cover would be able to absorb provisions for that as well. So we think capital buffers are adequate at the moment, but of course banks will have challenging times with probably NPLs going up in the context of low or negative economic growth this year.
So at the same time, the interest rates also, the higher interest rates also
so the
will
higher
have
interest rates will probably will help them to expand their margins, because I think you can see that bank FDs and things are still at about 12% or less mostly, and the treasury bills are now over 20%. So banks can arbitrage that rather than even if there's less demand for credit and so on. Yeah.
So based on your analysis, the banking sector is still, at the moment, it's still
yeah,
safe.
I think we would prefer the, I mean, if we were to rank the sectors that we prefer, I think the export-oriented companies and so on would be our recommendation, our top recommendations. Out of the domestic oriented sectors, we are still okay on the banking sector. Yeah.
Okay, and what would be your final message to your investors?
Yeah, I think you need to take. I mean, obviously, most investors are already taking a risk-off approach, and that would be the right approach to take. We can't tell investors to go out and buy stocks disregarding anything, because there'll be time to pick up stocks at bargain prices, because we expect that there'll be a fair amount of selling pressure, especially from the investors who are on margin and so on. So there's no need to rush in and buy, but we think this will be a great opportunity for the investors who have a long-term outlook to pick up stocks at bargain prices. I mean, you should selectively buy, like we said earlier, the stocks that have ability to hedge against inflation, or who have or which are at fundamentally sound stocks, which are at compelling valuation. So investors should selectively pick up those stocks at bargain prices, and they can expect to, or if over a 2-3 year horizon, to get decent returns from those stocks relative to where real interest rates are at the moment.
All right, thank you very much, Shehan. Thank you for being with Market Pulse. And ladies and gentlemen, that's Shehan Kure, the Director, Head of Research of Equity Stock Brokers. Thank you very much for joining with Market Pulse.
For more latest news, subscribe to FTTV.